Hey everyone, in today's video, I'm going to go through my $208,000 stock portfolio. I'm going to go through each of my positions, talk about which of the stocks that I am looking to buy more of, looking to debatably sell, looking to just hold on to for now and collect the dividends. Going to go through my Canadian stock portfolio as well as my US stock portfolio. So this is definitely going to be a long video. We're just going to start it off going through my overall portfolio and some background on it. So as you can see here, my Canadian portfolio is 140,000 Canadian dollars. It's up about 6% all time, and all time is from about October 11th, early October 2020, let's call it. So it's been about 2.5 years, or 3.5 years. So obviously in the Canadian side, not phenomenal results overall. At least I'm not down, especially with the volatility and some huge downwards moves we've seen in some sectors of the market over the last 3 years. So I'd say this is underperforming a bit or okay at best, but I'm not too fussed about it overall. You can see as I look at what I put into the account, which would be the gray line you see on the screen, versus the green line, which is the current unrealized value. It's really taken off over the last number of months in terms of finally going too positive, and it's kind of holding at that level where I'm up about $7,600 total. Going into my specific stocks here, we'll start at the top, Allied Properties. This is an office REIT in big cities in Toronto and other large cities across Canada, trading at $21.80 a share. This stock does about $2.20 to $2.30 of funds from operations. So this one's actually trading under 10 times funds from operations. Historically, as I look at the 5 year, this stock's actually traded 25 times funds from operations just because their assets are in really good locations. They had really good funds from operations growth over time. But kind of the macro trends in working from home, as well as interest rates paired with maybe less of a need for office space in big cities post-COVID, has really hampered the stock price. But we still see the funds from operations at equal levels as we saw it from before COVID. So this is a pretty interesting name. Just looking at my position in this one, I'm down about 24%, currently about $4,000 of market value. It is trading at an 8.1% dividend yield. So this is very uncharacteristic for this stock. Historically, it's traded at 3%, 4%, but it's really just been behind all of the stock price and equity weakness in this name that's got it up to over that 8% yield. So my thoughts on Allied Properties overall is I want to be really careful with how big of a position I make this across my portfolios because it's in a riskier spot. It's buying equity in an office REIT, and they have a lot of headwinds ahead of them. Lots of people are concerned that banks may not want to re-up the mortgages once they become due, or may charge exorbitant interest rates on those mortgages. The company continues to talk positively about their business and is maintaining that they're going to be paying out this 8.2% dividend. But at some point, I almost hope, just for the sake of protecting the rest of the equity and going forward on equity, that they take some of this cash flow and capital and buy back debt, so that's not as big of a risk in the near term of them needing to dilute shareholders by launching more equity in order to pay for debt if they can't get good financing terms. So that's one of my pet peeves with the company. But overall, operationally at least, they've shown still good results through this challenging time. I think this one, given the valuation at under 10 times funds from operations and the quality of their assets, it's one that I don't mind buying 5 shares here, 10 shares there on weakness, but it's definitely not a big bet that I'm making necessarily. So I can see myself going from 186 shares to, 200 shares, 210 shares, but it's not a position I'm looking to get to a $10,000, $20,000 position in this account by any means. I'll just, for the most part, take that monthly dividend that I'm getting, which is pretty juicy, and allocate it to other kind of lower risk opportunities. I'd say this stock is high risk. I can see it going down or up 50% depending on what happens in the market. Also high reward though. If this one goes back to the multiple it was trading at previously, this would be a $50 stock. So over 100% potential upside and getting paid over 8% a weight. So this is an interesting name, one that I'd say is a high risk, high reward REIT to have in the portfolio. Going on to stock number 2 here, A&W Royalty Income Fund. This company gets about a 4% top line royalty off of every sale that A&W restaurants do across Canada. They have about 1,000 locations. They are pretty well diversified in terms of the types of locations they have. I believe they have about 200 on highways, 200 in malls and strip malls and stuff like that. Then they have 300 or 400 standalone locations, followed by 200 or 300 in downtown cores. And those small format stores in downtown cores are really what's been driving a lot of new store growth for the business. And those stores are highly productive, provide a lot of top line revenue for the royalty fund to capitalize on. So we've seen them increase their dividend about half a cent, which is 3-4% a year over the last number of years. So this is one that has actually gone from, over the last 5 years, from around 13 cents a share payout to, I believe they're closer to 16 cents a share payout now. And the big starting payout on that currently is close to 6%. I think it's about 5.5%. So it's in a good spot in terms of valuation versus where it's been over the last number of years, trading at a much higher dividend rate than historical, because the stock price has kind of flattened while the dividend's gone up over time. So this is one that I think is just a pretty defensive stock to own. It's a quick service restaurant in Canada. It's not overly expensive, has a really loyal consumer base. So depending on, or regardless of what happens with the economy, I feel like this is a stock that will hold up decently well. It's paying me really good monthly cash flow. And I like how, and this is going to be a recurring theme as I continue to go through my portfolio here, but I really like how in these royalty stocks, in these royalty models, you're not subject to increase in cost of goods, labor costs, rent increases, stuff like that. Obviously, the economics of the overall business have to hold, or else restaurants will start shutting down. But short term, those adjustments and headwinds on the business have absolutely no impact on the revenues and the gross margins of the royalty fund. If anything, with costs going up and headwinds on labor, cost of goods, it tends to drive up prices, which actually has a positive impact on these royalty payments, assuming consumers still buy at the higher price points. In terms of what I'm doing on this one, jump the gun a bit. I just recently built this into a position that pays me about $1,000 a year in dividends. So I'm trying to hold at that for now. It's a pretty big position for me, almost $20,000 in A&W revenue royalty fund. So I'm holding here. I'm down about 4%, but I've been getting that monthly dividend of almost $100 for a while now. So I'm just going to hold. If it goes down to like $33, $32, prices that are just very attractive, I find, then yeah, I wouldn't mind nibbling in more and more. But I'd say it would be a similar story to Allied, where it's not really a focus area for me to grow my Canadian specific exposure throughout my account. So I would be very choiceful in how much I continue to allocate to this one. Currently, it's just a hold. That's just because I filled out my position versus the target I had it over the short term here to pay me about $1,000 a year in this account. Okay, going into my next spot, it is Scotiabank. So Scotiabank is a Big Five bank in Canada. The thing about the banks in Canada is they essentially have an oligopoly, and I really wish I had more than a 5-year chart to show you, because over the last 20, 30, 40 years, these companies have compounded greatly and provided a lot of total shareholder return, both through capital allocation, but also through dividend increases. Scotiabank's increased their dividend almost every year in the last 50 years. So as we look at their starting yield, which I believe is over 6% here, 6.3%, that's a great starting yield to get in, given their history, and if they're able to get through some of the challenges they're currently facing. and they continue to have that dividend growth CAGR that they've had in the last 10, 20, 30 years, you can be looking at easily yield on cost 5, 10 years from now that is in the teens. So I think the risk reward on this one is great. At the end of the day, the Canadian government is not going to let these companies go under or have any huge levels of financial pressure. So I think you have a bit of a backstop, a bit of a safety net with these stocks, and they're trading at really good valuations, even given the current market environment. I believe Scotiabank's trading at around a 9 times earnings, has an outlook from some analysts to be an 8 times forward-looking earnings. So that's a lot of free cash flow that you can get back, both as a shareholder directly through the 6.3% dividend yield, but then they're also yielding an additional 6% that they can buy back shares with, pay back debt, invest in new businesses, build out new businesses, acquire new businesses. So I just think the valuation on Scotiabank, historically speaking, for how well banks have done, especially the Canadian banks, given their market position, is really strong. And it's not my favorite bank overall, but it is one of the 3 Canadian banks that I hold. I haven't really added to it lately because I'm more focused on another bank, and I'll get to that later. But I do think it's a good company to have in the portfolio, and it's more of a hold for me right now. Okay, going into Canadian Apartment REIT. So this is the largest residential real estate owner in Canada in terms of apartment ownership. You can see here over the last number of years, they've gone up to about $60 a share, crashed down to 40, so got chopped by a third, now slowly making their way up to about $53 a share. Looking at this one here, they have about a $9 billion market cap. I believe they make just over $400 million in funds from operations a year. So they're currently trading at 21, 22 times. So this one, I was adding to a lot. I only have 100 shares in this account. I have this in a number of other accounts too, like my RSP. But I've been adding to it a lot lately when it was in the mid to high 40s. I'll probably hold now that it's over 50, trading over 20 times funds from operations. But this is a great business. It's so many tailwinds for housing in Canada, whether it is new Canadians and immigrants coming to the country, students coming in droves to do their education in Canada in the major cities, or the fact that we just have so much population growth, so many people moving out of their parents' houses right now, yet we have like almost no housing growth. So it's putting a lot of pressure on the rental markets and just prices overall. They're really well positioned to win today, but also win tomorrow as governments inevitably need to give support, tax breaks, incentives to companies like CAPREIT, which is what the short form for this company is, in order to help build that future for the Canadian economy. So I'm really bullish on CAPREIT overall. It's trading at a bit more of an expensive valuation, but there's good reasons for it. So I'm happy to own the position that I do have. They pay a monthly dividend of about 2.7%. I don't think this one's going to grow extraordinarily fast, both on the dividend rate as well as capital appreciation, but a lot less downside on this one, given the type of revenue streams and who's paying their rent relative to an office tenant or a retail tenant. So I do like having that in my portfolio. Up next is cash. So this is a high interest savings ETF. Essentially how this one works, it'll be pretty obvious when you look at the stock chart. They just collect value over the month as it sits in a high interest savings account. And then at the end of the month, it goes back to $50 a share. You get paid your dividend of whatever the high interest was worth that month, and you move on. So I just have this as a spot that I put some excess cash in. Currently I have about $12,000 in here, and I just get a monthly interest payment essentially through a dividend. And I just feel like this is a better place to put cash than holding it in a checking account or even most high interest savings accounts with banks. So this is really a cash position for me. And I think it's whether it's this or a high interest savings account or whatever else, with inflation running as high as it is and interest rates as high as it is, I personally, for my cash in my portfolio, I think it's a wasted opportunity to be holding 5 figures of cash in a checking account. Even at $10,000, you can be making $500 with very low risk and putting it in a different type of security that you can even just take that $500 a year or $50 a month, however you want to look at it, and invest it in bonds and stocks and other opportunities that you have financially. So this is my form of doing that. I'm sure there's other ones out there as well. Okay, going into CN Rail. CN Rail is probably my favorite stock in my entire portfolio. They have an incredible moat. No one's building railway tracks anymore. They're one of the only railways that go from the entire west of Canada all the way through the country to the east of Canada, and then all the way south through America pretty much. CP Rail just acquired Kansas City, which gives them a similar footprint and even farther down into Mexico. But they really do have exclusivity on some areas of the country in terms of the rail lines that they operate in. So huge moat. Like so many companies cannot conduct business in terms of moving their product around without CN Rail. So really good position. They continue talking and they continue acting on pricing over inflation, creating tangible value for shareholders over time. They buy back tons of shares. When I first bought this stock, it had about 800 million outstanding shares. They currently have about 660, I think. So they've bought back essentially 20% of the company just since I started owning the stock. They've also probably doubled their dividend since I started owning the stock in terms of the cash outlay. So currently yielding about 2%, but they do tend to do double-digit increases every single January. So this is a core holding for me across every single account that I have. It's not overly big in this one, but overall this is a huge position for my portfolio. I think it's a good source of dividend growth for the portfolio. It's stable growth, and it's one that I try to, no matter what the price is, it's such a core position that I always try to make sure I'm adding to it at least slightly every year across my account. So this is one that, despite the price, I'll bite the bullet and I'll buy 10, 20 shares in this account a year regardless, just to make sure I'm owning more and more of Canadian National Railway every single year. And that's compounded by the share buybacks as well. So over time, if you map out that formula, it's very lucrative in terms of the kind of wealth that this position can create over 10, 20, 25 years in it. Going to my next stock here, Diversified Royalty Corporation. Diversified Royalty Corporation is a royalty company. They own the rights to trademarks like Mr. Lube in Canada, Oxford Learning Centers. They also own the rights to Air Miles and a bunch of other businesses. They just expanded into the US with a commercial cleaning company, trademark rights, and they essentially just take all the royalties, all the revenues they get from those licensing trademarks, and they pay it back to shareholders every month. So currently paying an 8.7% yield. This is just a cash flow, a yield play, similar to A&W. I love the business model. No overhead costs, just money flowing straight into my account every month from the sales that these businesses generate. Then I'm able to take that money, reallocate it to other opportunities. This is one that, if the price was right, I would not mind building this position a bit higher, but it would really have to be at a super attractive valuation relative to what their earnings are. Once again, I'm trying to diversify a bit more out of Canada, which we'll talk about more later as I talk about some of my US stocks and how I'm planning on doing that. But this is one that isn't as big of a position as it could be. So it'd be one that I'd consider building up higher, but not an overly large focus for me. Okay, First Capital REIT, rather. So this stock here owns flagship assets across Canada in the retail sector. They've had a lot of challenges, and I can do a whole video on it, but they've had proxy fights and all these other things on how to create value for shareholders. They're currently paying about 5.5%. I think they do about $1.20, $1.25 in funds from operations. So trading at about 12 times, let's call it. This is one that I actually have just been holding. I haven't been buying any new shares of First Capital REIT for a while. I just feel like there's a lot of better opportunities in the REIT space at lower valuations, companies that have their crap together a lot less drama going on. So this is one that I've personally been staying away from, but I do still hold the position I have in the stocks. I love some of their assets. They have great flagship assets. Probably from a quality standpoint, the best retail REIT in Canada overall. They don't really have many bottom performing properties, and they do still pay a pretty good dividend. So I do like holding the company, but not one that I'm adding to by any means here. Continuing to go down the list. Fortis is a utility company, regulated utility company for the most part. They pay a 4% dividend, and they have a mandate to increase the dividend about 6% a year. So you're pretty much buying, obviously a bit more risk to it, but about a 4% bond with 6% increases. So it'll go 4% to 4.3% to 4.7% to 5% yield on current costs. So I really like their dividend growth over time, and you get a decent starting yield too. Relatively safe business overall with the regulation of their revenue streams. You can see over time, over the last 5 years, they returned about 7-ish% a year in capital appreciation, in addition to the 4% dividend that's been pretty stable over the last 5 years. So you've gotten over a 10% return compounded over the last 5 years if you've stayed in the stock. Okay, trying to move a bit faster here. A couple of these companies are sheerly for cash flow. So I'm primarily a dividend investor. I like getting a big dividend check at the end of each month and throughout the month, reinvesting it, fueling that snowball effect. So I've really started investing in some covered call ETFs to really accelerate my dividend income on a monthly basis. HDIF was one of those. It's a levered, diversified monthly income ETF that uses covered call strategies. Overall, I'm down about 2% on the position over the last year, but I've generated about 10% yield. So overall, it's actually done pretty well for me on this one here. Going into the next one, it's a bit more of a specific covered call play. It's around global utility stocks. So think about, telecom stocks, railway stocks, pipeline stocks, all those relatively high yielding companies from all over the world put into one stock. You can kind of see here, I'm down about 5% on the name. Company's down about 10% over the last year. I think I bought the dip a bit, so got a bit lucky there. Overall, got paid about an 8% dividend out. So not up as much as HDIF, but still net positive, even though not a fantastic return necessarily. JWell, this is one that I just started touching into. I've owned the stock before. I think I sold it for $40 during the pandemic. Yeah, probably up here. I got out of it at a pretty good rate. And I just like this business overall. So a couple days ago, I started nibbling in, currently at 11 shares, only $300. But this company's going to do $1.70 in EPS, so trading at about 16 times earnings. They've compounded top line and bottom line growth at 10% plus over the last 5 and 10 years. So I just think for the opportunity in the wellness space, for the geographical opportunities they have in the US, in China, this one's trading at a very attractive valuation, especially when you look at other consumer products companies with less tailwinds that don't play exclusively in wellness, that are trading at 20, 25, 27 times earnings, like PepsiCo and companies like that. So I think this is a good business, trading at a very attractive valuation. You're also getting a 2.5% dividend. They tend to do big dividend increases every year too, because their payout ratio is pretty low. Small position, just looking to see if this one goes down anymore to build it up a bit. If it goes up, I'll just take a small profit because I'm just kind of playing around in this one because I think the overall story is good. Keg Royalty, very similar story to A&W Royalty, just a bit less defensive. This is a more luxury product. It's sit-down restaurant. It's a steakhouse. So in a poor economic time, this one may get hit a bit more. Because of that, it trades at a bit of a lower multiple. You get almost a 7.3% yield here. So this one is a bit more of a risk play, getting rewarded with a bit of a higher monthly dividend on this one. I have a pretty small position in this account, only about $1,000, but I do hold this in a few other accounts. I think overall, my position in the Keg Royalty is closer to $18,000. So it is a meaningful position for me overall, just not so much in this specific account. Going on, another cover call ETF. So once again, this is just for monthly income enhancement. This is a global covered call healthcare ETF. Think companies like Pfizer, Merck, AbbVie. So just taking their dividend, writing off the premiums, getting those premiums for selling the upside in the stock. This company, I'm down about 5% on overall, decent sized position, about $7,000, and I've gotten about 9% back in yield over the last year. So similar story as some of the other ones. Overall, stock hasn't done great, but the yield's made up for it, up about 4 or 5% in terms of total shareholder return. Oh, this one is one that's painful to talk about. Northwest Healthcare is my worst performing stock I think I've ever owned. I need to look into it more, but it's just so painful that I've been avoiding it. Down 50% in the last year. I know they took on a lot of debt for an acquisition in the UK. They said they were going to do a joint venture on it to kind of repay some of that debt and drive confidence in the purchase price. Their partner backed out of the deal, which raised a lot of questions on due diligence and why they did, if they thought it was overvalued, so on and so forth. I think they also have a pretty big management business of hospitals, and lots of Wall Street and Bay Street may have underestimated how volatile that fee income is. And over the last couple of years, with interest rates going up, it seems like whatever performance metrics they get scorecarded on, that area of their revenue has not met expectations. But overall, I think they did about 80 cents funds from operation trailing. The CEO still mapped out a plan over the next 2-3 years, medium term, to get funds from operations to $1 a share. If that actually happens, you're paying about a 6.5 times earnings for a company that has weighted average leases of 20-30 years, inflation adjustment, rent increases built in. So a huge risk reward opportunity on this one. I need to look into it now to better understand the downside, to be honest. Once again, I've been avoiding it just because this one's painful. Down $3,000. Dividend yields at 12%. Don't think it's sustainable, to be honest. They're paying out about 80 cents a share, and that's exactly what they made last year in funds from operations. So no room to fuel growth there at all. Okay, moving on. QSR. This company, Restaurant Brands International, owns Popeyes. They own Burger King. They own Firehouse Subs. They own Tim Hortons. They recently acquired Firehouse Subs, actually, still a very small part of the business. But in the last year, this company's done phenomenal, up 50%. This has been one of my biggest winners in this account, up over $3,100, 35% up, pays a 3% dividend. This is one that I, frankly, am not buying any more of at these valuations. I think it's a bit pricey, especially for the brands they hold versus some of their competitors. So this is one that I'm just taking the dividends, investing their dividends in other opportunities I see in my portfolio, most of which we haven't got to yet, so I'll get to those in a minute. But was really fortunate to get into this one where I did. Still like the business, just think it's a run a bit. Rogers Communication. This is a Canadian telecom play for me. This one has traded sideways over the last year. Even as I look over the last 5 years, it's traded mostly sideways, actually down about 10%, so it's down. They do pay a bit of a dividend, 3.5% give or take. This company just acquired Shaw, which is a big telecom company in Canada from out west. And on this one, I'm just kind of waiting and seeing how the Shaw integration goes, what it means for diluted shares, what it means for the new earnings per share. Also want to get a sense for how the decline in cable is going to impact their business over time. I haven't seen a big impact yet, but just looking at the telecom market in the US and the value destruction that's happened there, I'm a bit wary of getting into it in a big way. With that being said, they do own a lot of great assets. They're the biggest wireless company in Canada in terms of phone plans. They also own businesses like partial ownership of Maple Leaf Sports Entertainment that owns the Raptors, owns the Leafs. They own the Toronto Blue Jays outright. So they have some great media and sports assets. So currently own about $5,000 in this portfolio. I want to give it a couple quarters, see how everything's going with Shaw and earnings per share. This is one that I consider nibbling on, similar to my rhetoric on some of the other names that I talked about. Riocan is my favorite retail REIT. This stock is going to make about $1.80 a share this year. So we're trading under 11 times funds from operations. They're managed very well. They buy back shares when their equity is too cheap. They buy back debt when interest rates are too high. They have a really good business model in terms of the amount they pay out to shareholders versus how much they keep to invest back in the business. And they've been upgrading their assets over the last number of years. They are flat over the last year. Over the last 5 years, the company's actually down. They never have fully recovered from COVID. Lots of that's just some of the rhetoric around some of their office exposure, which is a pretty minimal in the grand scheme of things. Interest rates going up to have just sunk the REIT sector overall. But this is a great business, great cash cow. They used to trade 15, 16 times earnings, now trading at about 11, paying a 5.5% dividend yield. And that's not even at too high of a payout ratio. I think they keep 30, 40% of their earnings to reinvest in the business or allocate as they see fit. So I just think this is a great business model, great assets, great management team. Will do well over time. It is one of my biggest positions, not in this account, but as a whole across my accounts. So it's one that I haven't been adding to, and I probably won't add to despite it being one of my favorite REIT stocks, just as I have other focus areas that once again, I promise I will be getting to in this video. TD. So TD Bank is actually my favorite bank, and it's actually a stock that I have been adding to, and I'm looking to add to more. I just recently added it to this account. I've had it in a lot of my other accounts once again, but would love to make TD a bigger position. They're going to do about $8.60 this year, so trading at under 10 times earnings. Their first Horizon deal in the US, which was supposed to be $11 billion, which would be worth about 8-9% of the company, 8% give or take, just fell through. So they have tons of cash on hand. They can buy back tons of stock. They can go and do other strategic acquisitions if need be. But this company is just positioned very well. Huge commercial bank, which is less volatile than capital markets and some other segments of banking, which I really like. They only operate in Canada and the US, so really stable, really strong economic markets. And they have a really strong brand, really good position with consumers in those markets. So I really like this company. I think they have a lot of room to grow. And in addition to that, I think they're well positioned in terms of their debt management, their conservatism, the amount of cash they have on hand, and their valuation. So this is my favorite bank stock. It's my biggest bank position if I look holistically across my accounts, and it's one that I am allocating new income into and new capital into as I get all those dividends from those REITs, from those other stocks we talked. This is one that I've been taking those dollars and starting to buy more shares of here at under 10 times earnings. I'm going to talk about these three ETFs very quickly, super high level. ZDI is an international dividend ETF. Essentially, they just hold big blue chip dividend paying stocks from Europe, Japan, Australia, areas of the world like that. And the dividends actually grown over time, which is great to see. Think about companies like L'Oreal, Estee Lauder, Nestle, LVMH, etc. These companies that are from Europe and from other areas of the world that give me some broader exposure. And before the stock really ran up to about $22 a share, I was buying a lot of it. You can see I added $10,000 into it. I'm up about 12% before the dividend. And the purpose of that was to get my Canadian a bit less Canadianized, a bit less North American based, and get some of that exposure from other areas of the world. On this name here, I think I'm good on it for now across my accounts, given how much I've put into it. I also don't like paying the 0.5% management fee for an ETF that's not writing covered calls, but it was really important for me to build that position up. ZWB is a covered call on Canadian banks, so they own all the big Canadian banking and financial institution stocks, write covered calls against it. Pays me about a 7-8% dividend a year. Since banking's been down, I think I'm net down on that one actually, but it's one that I'm going to continue to hold, and I like getting that monthly income. ZWC writes covered calls on all high-paying Canadian dividend stocks. Think Bell, Pembina, I'm just throwing names out there, Enbridge, etc. They own all those stocks and accounts. You get paid out their dividend, but also the premiums from selling the upside, or I think 2/3 of the upside on those stocks as well. So a good formula to generate a lot of income once again, I just take all that income every month from these cover call ETFs, allocate them to strategic areas of my portfolio. So as I look at my Canadian side of my portfolio, a couple of the areas that I'm really focused on adding to continue to be nibbling into companies like CN Rail a bit, nibbling into some of these royalty funds and REITs that are, when they get a bit undervalued. But generally, the only stock that I'm looking at building up in a big way on my Canadian side of my portfolio is TD Bank, just because of the quality of it, the fact that they do have a big US presence there. So I am getting out of Canada a bit in terms of my exposure and the valuation, paired with the fact that it's still paying almost a 5% dividend rate. So that is my Canadian side of my portfolio. I'm going to jump across into the US side here. The US side of my portfolio has done phenomenal. I'm up 20%, and this one actually just started in Feb of 2022. So this portfolio is under a year and a half old, and I'm up 20% on it, over 8,500 US dollars. You can see that I was down in this account at the beginning of this year. So since January 1st, I'm up over 20% in this account, which is really great to see. We're going to go through and show how that happened. I'm going to start off with Google. Google is a great business. As I look at my position here, I'm up 22%. I own about $4,000. This one is one of the few companies I own. I think Google, Amazon in another account, and Meta are the only companies I own that do not pay a dividend. And that just goes to show my thoughts on their business model. I think they're a cash cow on the advertising side. I love their YouTube business. I think that has a lot of runway as well. And I'm just really focused on them better building out cloud for that to be another profit and cash flow generator. Even if it's taking a long time, I think that's a good focus area. I hate their other bets divisions. If you look at all the money they've burned there over the last 10 years, they could have bought huge businesses, but instead they don't really have much to show for it. But I'll let that pass. Overall, I think this is a great business. I think they're really well positioned in technology. But I'm really focused on dividend income right now and accelerating my annual dividends. So this is one that I haven't been buying much lately. I probably won't start buying as well unless it gets to a stupidly low valuation, and the risk reward at that time feels like it's unpassable. Coca-Cola, this is one that I have been aggressively building. I did not own Coca-Cola 3 months ago. About 8,000 US dollars in it right now, 131 shares. I'm trying to get it to 150 shares right now, and then I'll see how the earnings goes. If I think it's still reasonably priced after earnings, wouldn't mind getting this to 200, 250 shares. This stock is not cheap. I think they're going to do about $2.50 in earnings, so it's trading at about 24 times multiple here. So definitely not a cheap stock, but it's a stock that I think can be a core part of a dividend portfolio, and I love their global exposure. Similar to how I was buying ZDI for that global exposure, Coca-Cola operates in so many different markets around the world, also has a lot of feelings of that royalty model with the bottlers that they give their product to, and they just get royalties and revenues back, very low capex involved in that. So love the business model, love their brands, love their global diversification, and love how defensive this business is too. They have retail, they also have restaurant business and events and stuff like that. So I don't think it's a cheap stock, but I think over the long term I should do well with it. I get a starting yield of 3%, and they increase it for over 50 years in a row. I think 20, 30 years from now, my yield on cost will be very, very good, and I won't regret building this into at least a medium-sized position. So this is where the vast majority of the dividends I've been getting from across my portfolio are going every month to build this position. I don't want to say for free, but without putting too much new capital into the account, this position is really being built from the profits from lots of my other stocks throughout 2023 here. Going into my next stock here, McDonald's. I've owned McDonald's in other accounts for a long time. In this account, I only have about $2,000, up almost 30%. Pays a 2% dividend here, also increases it every year like Coca-Cola. So McDonald's, I think, is going to do about $10 in EPS. So we're trading at like 30 times earnings for a fast food company. I know they're global as well. They own a lot of real estate. This is too expensive for me to buy more McDonald's. So this is one I'm just holding on. It's a core stock for me in other accounts. So I'm not going to sell it. I'm going to keep taking that dividend, putting it in other stocks like Coca-Cola. But this is expensive. I would not be buying McDonald's fresh today, in my opinion. So really glad I got in when I did. This is definitely just a hold for me today, though. Meta in this account is up almost 200%, which is crazy to see. While I'm up almost 200% in this account, my average price in other accounts are probably closer to $160, $170. So probably up 70, 80%. And I've been holding Meta for years and years. So my total shareholder return annualized on Meta is decent. It is not fantastic overall, given my average prices in the stock. I think Meta has a great business on the advertising side. I think it's extremely irresponsible to invest how they have and how aggressively they have, especially in the times we're in the metaverse. So I lost a lot of faith in the company during that point, but I did not sell the stock. I'm super happy I didn't, because it's rebounded super nicely here. And this is one that I have no interest in buying more of. If anything, I'm looking at maybe limiting my position here relative to where it is. It's probably the fourth or fifth biggest position across all my accounts, given how much it's run in the last year or two. So this is one that I may actually source from, fuel other dividend paying equities instead of Meta. Microsoft, while Microsoft has run a lot, I have no interest in trimming this stock at all. I think Microsoft is a great business, operates in a lot of different really vital industries for the future. They own LinkedIn. They just acquired, or are about to acquire, Activision, own Xbox. They have a huge gaming presence, huge presence with businesses, with Office 365, HP, and all their other hardware businesses. They're just in so many places, and so many of those places are the right places to be, that I really don't want to trim my Microsoft position at all. I was actually adding to Microsoft when it went to 250, 240, 230. They also have a great partnership and own a part of ChatGPT or OpenAI. So excited to see over the next 5-10 years what they can do as a leader in AI, and how much value they can create for the global economy. This is not one, despite running up in valuation a lot here in the last, let's call it 3 months, up 20%. In the last, here we go, from January, they're up about 30-40%, give or take, year to date. Given the run up, it's not one I'm interested in trimming. I probably won't be buying any more shares here across my accounts, but it's one that I am happy I have a good presence in, up 40% in this account. So as we look at the whole account being up 20% on the US side, this is one of the drivers of that performance. Realty income, similar to Coca-Cola, this has been a relatively new position for me. I'm also trying to build up to about 150 shares in this account, and this is where lots of the dividend income that I have going in is going towards, and it's just continuing to fuel more and more dividends. As a dividend snowball does do, I'm using my dividends to buy realty income, to buy Coca-Cola. Then realty income is now paying me $40 a month in dividends itself, which next month I'll take to buy more realty income, more Coca-Cola, and eventually, when those positions are at spots I feel comfortable, I pretty much have 2 new income sources: realty income on a monthly basis, Coca-Cola on a quarterly basis, just continuing to provide more and more snow for my snowball to buy future stocks or make some of these positions even larger. But I really like realty income in the sense that they're in every single state in the US. They've recently expanded to Europe. They have properties in the UK, Italy, Spain. So I think instead of having so much of my REIT exposure specifically in Canada, it's giving me some of that global diversification, which I'm striving for. P&G is a stock that I'm up a decent amount, 11-12% in this one. They've increased their dividend every year, starting yield of 2.5%. It's not a stock I'm buying more of in this account, because I really view them and Coca-Cola as pretty similar deliverables, and I'm really hoping to build Coca-Cola more. Just given the price point of their products, I think probably a bit more of a defensive business, a bit more global, less situated on the U.S. economy. So that's why I'm kind of going Coca-Cola over P&G in this point of time. Going to my last couple stocks here, AT&T. I said Northwest Healthcare was my biggest loser in my account that I've ever had. I think AT&T is up there. So I think probably my second or third worst ever performing stock is AT&T. I keep getting just hung up on the valuation and how cheap the valuation is. AT&T still said they're going to do $16 billion in free cash flow this year, which puts them trading at about a 7 times multiple, 6 to 7 times multiple. They pay over a 7% dividend. They still have ample amounts of cash to buy down debt, to invest in new business opportunities. Despite cable going down, they do have some areas of their business that are really strong, are growing. So I just think that the price to earnings and price to free cash flow ratio on the stock is too small. I wouldn't mind nibbling on this a bit more, but similar to how I viewed Allied Properties, I wouldn't want to make this into like a huge position or anything like that because it's not the best overall business. And I should realistically be focusing on businesses I feel like are more secure, better positioned for the long run. But it's really hard to turn down these stocks that I think have just been beaten up way too far. Valuations under 7 times funds from operations when they're so shareholder friendly, returning that capital on a quarterly basis for me to invest in other stocks as well. The next stock is probably one of my favorite stocks behind C and Rail in my portfolio. Visa is essentially a royalty on the global economy. In addition to being a royalty on the global economy across travel and every sector, they also have the additional accelerator, the additional tailwind of benefiting from cash transactions moving to online and moving to card. So I just think they have a huge tailwind ahead of them. I made a video at the beginning of the year how this was my #1 stock to buy this year. I still stand by that. Even though the stock's run up about 20%, I really like Visa. I've been buying more shares of Visa, despite buying more at high prices, still weighted up 16% because I started buying this stock in the 190s, give or take. Really small dividend, but I'm not buying it for the dividend for the most part. They do increase their dividend big time, but they also buy back tons of shares. They have some of the best net margins I've seen on any publicly traded company. And I think that over the long term, this company can easily make $10, $12 EPS in the medium term even, which would put this at a 20 to 25 times multiple stock. Lastly, a real estate company that I just find interesting. I think they have a great management team. I haven't got into this one in a big way. I have about $1,000 US in it. Pay about a 5% dividend annually, so making about $50 US a year. Not a big deal yet. Still deciding what I want to do with this position. We'll see where the stock goes. We'll see how the earnings calls goes. We'll see what some of the other stocks I'm looking to build up do in terms of price action. But I think their management team is super good. Love the way they talk about the business. I've listened to lots of their earnings calls. And this is one that I just wanted to be a part of, or at least have a bit of an option and interest in as I figure out if I want to be in this stock long term. VICI Properties owns a ton of the Las Vegas Strip. In addition to trading at about a 14 to 15 times funds from operation, they have inflation adjustment rents placed into their long-term contracts. They collected 100% of their rent during the COVID pandemic. And in addition to that, they have tons of unused acreage and property across Las Vegas and other areas of the United States that they can either sell off, use that cash to buy back shares or monetize through new asset purchases, or they can develop and get new revenue streams. So if they're able to monetize those effectively, plus the inflation adjusted rent increases, I can see buying it at the current price be like buying at 12, 11 times funds from operation, which given how essential the real estate is for the tenants that hold the real estate, is very, very high likelihood that that rent's going to get paid. They have a huge moat in that sense that their tenants really need their real estate to operate effectively, whereas other retailers may be able to pivot to online and other stuff more effectively. So I think they are just really well positioned. They deserve to be trading at a good multiple, and I think that they also have lots of revenue and funds from operation on an absolute basis, tailwinds that over the next 5 years will position this stock in a good spot, and you get paid a 5% dividend, give or take, to wait it out. So that is my $208,000 Wealthsimple Portfolio. You can see here it's primarily on the Canadian side, but I have been trying to build more and more of my US positions out bigger. Some of my biggest focus stocks across the US side, Coca-Cola, Realty Income, and then trying to figure out what I want to do with VICI. In the meantime, continuing to bite on Visa a bit. So this is where I'd say all of my dividend income that I'm getting put into my account every month across all my accounts, these are the positions that those stocks are going to buying me more equity, more shares in on a monthly basis, in addition to TD on the Canadian side of my account. So I hope you guys like me going through my portfolio like this, like my perspective on why I'm buying which stocks, why I'm not buying other stocks, talking about some of these stocks a bit. If you like this video, be sure to give the video a big thumbs up, especially if you made it through to the end. Not everyone does. Hitting the thumbs up button really does help with the YouTube algorithm and really does help my small channel reach more people. So I'd really appreciate it if you just take a second to do that. Also, if you haven't yet, please consider subscribing to the channel. Really means a lot to me, really does a lot for the channel as well. Thank you guys so much for watching, and I'll see you in the next one.